Our assessment is that the economy will grow this year at about 2.6% and next year at around 2%. And this represents an increase from our initial growth forecast by 0.3%. So lots of positives and a lot to be proud of. It would also include raising indirect taxation. Over the first few months of this year, financial market conditions have improved markedly. This is good for near-term growth, reducing the cost and increasing access to financing. But obviously we're concerned about the risk of an abrupt reversal of financial market conditions that could represent a material downside risk in the US. And in particular, a sudden tightening of financial conditions could interact adversely with the high level of private, public, corporate households and sovereign debt, and could create a feedback loop that would also weigh on real activity and job creations.
Because it takes some time and there's some lags involved, and certainly if the tariffs are increased, we would expect eventually those effects to turn up both.
As you know, earlier this year, the Federal Reserve has indicated that it was pausing its process of raising interest rates. We fully agree with that approach and believe that this will give policymakers time to gauge the balance of risks to both inflation and employment outcome.
Thank you. Anything further in the room? Okay, we can.
We believe that for the global economy to actually function well, it needs to be able to rely on a more open, more stable, more transparent, more predictable, and rules-based international trade system.
The impact it can have to third countries, and we saw
it will be essential for the US and all its trading partners, including the likes of China, Mexico, and others, to agree on a new system, to agree to eliminate the distortions that put a brake on growth, administration, and of Congress. And as I've said many times, nobody wins a trade war and everybody suffers.
Thank you very much, Madame Lagarde. Okay, so